Welcome to Breaking Ground. I'm Steve Kliegerman. I'm honored to be joined today by Robin Schneiderman, SVP of Business Development and Senior Managing Director of Brown Harris Stevens Development Marketing, and Jason Thomas, our SVP of Research and Analytics. It's great to have you guys back. It's the end of the first quarter. It's time to talk all things market reports and analytics. So New York City's first quarter Manhattan market report saw more deals over $10 million than in the last decade. Robin, what do you attribute this to?
It's a good question, because I think we're all fascinated with the level and the depth of money that is around at this corridor. I mean, to see the number of deals above $10 million, I believe it eclipsed it by, what was the percentage, Jason?
It almost tripled it. So 56 this quarter versus a 10-year average of 20.
Yeah. I mean, one of the highlights is certainly 1122 Madison Avenue. That was a long-term assemblage by Legion and Nala Capital. I think there were a lot of well-to-do Upper East Siders that were waiting for that specific project. So when it came on, the people were ready to snap it up, and besides $10 million, that project specifically, I think, is in excess of $5,000 per square foot, which is another record for the Upper East Side on a blended basis.
Especially off of the park.
Correct.
Right? Without park views, really, as well, right?
Yeah, I think maybe like the top 5 stories have park views.
Right. So when you say a long-term assemblage, how long did it take them approximately to put something like that together? I think it's important for people to understand just how long it takes these deals from beginning to end.
Yeah, I think it took probably somewhere between 5 and 6 years. And also there were some benefits to the zoning changes with City of Yes. So they were also able to get some additional height and FAR in the project.
Yeah, that's amazing. They're doing absolutely incredible. Jason, when you take a look at these numbers, what does it say to you, and how, does it change in any way the way you view the marketplace?
I think it doesn't change anything, and I'm not surprised. I think it just validates our thesis, and that thesis has been that, as we've talked about, the contract numbers are only a portion of demand, right? It's the matching efficiency between buyers and product, right? So you can have 300 contracts signed one quarter and 250 the next, and it doesn't mean that the demand has gone down. It just meant that the matching efficiency between buyer and product, again, was better in the earlier quarter, right? So I just think this 1122 Madison, the 56 contracts above 10 million, it just validates that what we believe, that the demand is much stronger than what the contract numbers show. So if there is quality product out there, there is plenty of demand to absorb that product. Yeah. And I think the other part of it too, we don't track this, but Wall Street bonuses were extremely high this quarter. So I think that had something to do with it.
Sure.
Or at least that's a hypothesis, right?
Yeah. So, well, certainly when more money is flowing, into the pockets of those who are consumers, we know that consumers are going to spend that money.
Exactly.
They'll save some of it, but they're not going to save all of it. And for a lot of these folks, it's the first time they've actually had an opportunity to really reap the benefits of all their years of work, right?
Sure.
So they want to buy something that establishes them in that realm as well. And I'm sure it's also good for business. Someone's buying a $10 million home and they're entertaining at that home with clients. It's super impressive.
Sure.
So, Robin, what does this tell you going forward? As you're looking at deals with clients, what does this tell you when you're evaluating an opportunity versus a couple of years ago, when there wasn't as much $10 million and up activity?
Well, first of all, I think we all tend to forget the 3 famous words: location, location, location. I mean, it really is even more apparent as we go forward that buyers are really, really focused on where they want to live. And that's just a perfect example of what Jason was talking about the actual product and when it comes out, people are ready to buy. And then, you guys know I always love to talk about supply and demand. We've been really coming down over the last several years. We're finally, I think, at somewhere around 3,500 units of total inventory in Manhattan new development, which is probably 60% below the high over the last 5 or 6 years. So there's definitely a need for product, and we're seeing it not just at the 10 million plus, but there's been a few projects that came on the market downtown in prime locations. There was a small project, but something that I thought was really interesting was 220 East 9th Street. It was 20 apartments or so, sold off floor plans in a converted garage, like loft style residences. So it's just another example of we need better product in prime locations. But with all of that exciting absorption happening, there are areas of the market that are faltering, that are not selling as well. So it's the word I've been using lately is bifurcated.
Yeah.
The market is truly as bifurcated as I have ever seen it.
Yeah, that's a really good point. Why do you think those projects that aren't selling as well are faltering? Is it simply location? Is it price? Is it quality? Is it the wrong unit mix? I know you don't have the answer to everything, but what to you is, you've seen a lot of these projects, you've looked at a lot of these projects. What to you is the common theme in some of those projects that are not performing as well as the more prime locations?
Well, I think one of the aspects is that when these deals were originally purchased or underwritten, first of all, mortgage rates were basically half, right? As we always say in the new development business, each project is can be a 3 to 4 year cycle. So if you go back 3 years, the developers, right, were purchasing sites and financing them with 3 to 4% money, and now all of a sudden they're delivering the product, and the purchasers, have to pay 6.5% to even 7% for mortgage rates. So I think that's impacted some of the underwriting for the developer, and the consumer is not, completely there and ready to purchase because their expenses have changed, right? They have higher mortgage costs. I mean, we're talking about real estate taxes are I think at an all-time high now.
All-time high.
I mean, we go through these budgets, these Schedule Bs before we go to market, and we just read one recently, and I was floored with, I think it was about almost $2.20 per square foot just for real estate taxes.
Yeah, just for taxes.
Yeah. So I think you factor in a lot of this increased cost to carry apartments, and I think it's starting to eat into some of the absorption that some developers originally underwritten in these tertiary locations. I think that's like the sort of the overarching theme that I'm feeling, and of course a lot of the stuff you talked about is like finishes, layouts, they all have their own little individual stories, but I think that the big factors are what the expenses are happening in New York.
Yeah, and I think that in those secondary markets, again, a secondary market within a city that's that's tremendous. I think that the buyers also are surprised when those carrying costs in the secondary market are the same as in the primary market, right? So they're saying, well, if I'm going to spend that money anyway, maybe to be in a little bit better location, it's worth spending a little bit more money to get a more centrally located home. I also think that parents buying with their adult age children has a lot to do with it, because they have very specific ideas about where they want their adult children to live, or where they think is safe, or where they think is a good investment. Mm-hmm. And because of that, and with rising interest rates, more cash deals are happening, so the parents have a little bit more sway than they would if it was a lower interest rate environment, where maybe they're gifting or lending them some of the money, but then the occupant adult will take over the financial burden, right? So the parents are saying, well, if you're going to buy, then you better buy on 9th Street instead of on 38th Street and 10th Avenue or whatever it might be, right?
Yeah. And we want you to have a doorman.
Right. Right.
I think we just lost a deal because of that.
Yeah, exactly. So Jason, going to that, one of the things that we saw was that, and you started to talk about it earlier, is that dollar volume well, dollar volume over $10 million was up, and deal flow over $10 million was up, but the total number of contracts is actually contracting. And we talked about supply, demand, and absorption, right? So we're going to take a quick break, but when we come back, what I would like to start talking about is what's the difference between demand and absorption. We'll be right back.
From residential and commercial closings to litigation, Romer DeBoss is your full-service real estate law firm. We blend big firm knowledge with boutique-level attention, delivering outcomes that exceed every expectation. Contact us at romerdeboss.com.
All right, welcome back. So, Jason, you and I have this conversation quite often, and we actually just had a quite vibrant conversation about the differences between supply, demand, and absorption. Because I think when you look at some of these market reports, particularly as Robin mentioned, there's not a lot of supply out there right now, right? And there's not a lot in the pipeline, which we'll get to in a few minutes. So when that happens, how do you reconcile when you're reading other reports or you're talking to reporters and they see that deal flow is down? Does that mean that demand is down?
Well, so demand by its very nature remains a mystery, right? I mean, it really does, right? There's no way to understand true demand, right? But the number, so when many people look at these reports, they see, contract signed, decreasing, or on the opposite end, they can see it jump to a very high level, and people interpret that as total demand, right? So total demand has dropped or total demand is much higher. And oftentimes that's not the case. The demand may actually be quite stable all the way through. It's just what I mentioned before. It's that matching efficiency. So you have buyers that have specific needs, and you have products that answer specific needs. And if they match, then a deal is consummated. And if not, that buyer is pushed into the next quarter, or the next quarter, and the next year. So you can see spikes or troughs that are really demand someone that's been in the market for months or years, right? So that's the big thing, is that we have to take what we consider demand, or not what we, right, but the industry considers demand, with a grain of salt. Because what the industry considers demand is actually just contract signed or consummated, which is just matching efficiency.
Right.
I think, and we've hypothesized that demand is relatively stable all the time. And again, this is where the 56 contracts at the high end, it shows that. I think it's just a testament to that, right? Like you build quality product and the demand has been there. Is it really that all of a sudden there was just that much 3x demand for the Upper East Side? It's always been popular, right? It's one of the most popular neighborhoods.
Particularly the last 5 years. Yeah.
Right.
Yeah.
So I don't think it just demand tripled in the last quarter. I think it's been there. And a lot of this too is pent-up demand, right? It's not really 3x this quarter.
Right.
It was last quarter, the last, and maybe last year. Maybe people have been waiting for years.
Right.
So that's the big difference.
Yeah. So going back to using 1122 Madison as an example, it's absorbed like hotcakes because the product was there. The demand had been there.
Right.
It was waiting for the product, right? So what we are trying to do now with our reporting is we're really looking at absorption. We're looking at supply and absorption, because we do believe that if you build it, they will come, as long as you build it in the right location and you build it at the right quality. And I think 80 Clarkson is a great example of that. I know we don't have exact numbers on 80 Clarkson because they've miraculously, and you got to give a tremendous amount of credit to Zeckendorf and Atlas for this, have sold 60+% of that building without any public information about their actual sales, which is not typically how a successful project sells, right? You have a couple of examples at the high end of that happening, but you look at an 80 Clarkson where it's about 60 to 70% sold. We know that they announced a $129 million sale. They announced a couple of very other high sales. Another project, Robin, where if someone told you 5 or 7 years ago that someone was going to build a building in Hudson Square at 80 Clarkson and average, close to 7,000 a square foot, I think you probably would have told them they were crazy.
I would definitely.
Right? So what changed, in your opinion? What changed to create such absorption and demand?
Yeah, I mean, well, for that one in particular, it's just so rare to be able to build that scale, right, and that level of a building on the water, downtown, right? I mean, it also, I think it's, I don't know the exact percentage, but it's got to be 15 to 20 stories taller than any of the other surrounding buildings on the water. So the views are there, they're protected, which everybody, always loves in Manhattan. It's very hard to find. And they're bringing a level of service that's akin to the 15 CPW experience. And from what I understand from just talking to people, it's a lot of people that bought in the other West Village waterfront buildings that have the appetite to purchase something at this level, right? And they can afford it, and they're waiting for something, new and fresh and exciting.
Right.
So that's brought a tremendous amount of buyers to that one particular.
And interesting because
not a lot of foreign money.
No,
it's all local.
It's mostly domestic, from what I understand. And it's interesting that you said that because it makes a lot of sense, because a lot of the buyers that bought in those buildings are selling at a premium as well, right? So they bought early, they adapted to the neighborhood before it really changed.
Yeah.
And now they're able to sell their homes. Not that they need the money, but it's always nice to be able to make a profit, right? And roll that then in to their purchase at 80 Clarkson. So the brokers who sold them those apartments that are going to be listing those must be absolutely dying to get them on the market and start closing at 80 and start closing their unit at 80
There's
Clarkson.
not that many examples of residential new developments over the last decade that have had a significant appreciation.
Right.
150 Charles is a classic example.
That's right.
I think you were just doing some of the stats on that one.
Yeah, I've been tracking it for years. It was interesting because it was probably the fastest sellout dollar volume in New York City history. And to both your points, the way that one pencils is people bought it at X or selling at 2X, and that's a sideways trade right into an 80 Clarkson.
Exactly.
Right? And that's really interesting because you're essentially just trading 10-year-old product for brand new product, right? And that's a really interesting trade.
Yeah, and as we continue to sort of watch this evolve, it's really difficult to buy a development site where you can build something of that magnitude, right? Or attempt to go the other way, which is through assemblage. And assemblage, like the 1122 example, took several years, which took some of these other Upper East Side new developments up and down 2nd and 3rd Avenue are long-term assemblages. So it'll be interesting to see as we go forward what the depth of this buyer pool, especially on the Upper East Side, I think is the one neighborhood as we look to the future that has a significant amount of supply coming.
Do you think that's actually going to have a potentially negative impact on potential pricing?
I don't think it'll have a negative impact on pricing. What I'm most curious to see is how long it takes to absorption.
It.
Yeah, I think that the buyer pool exists, but I think we were doing some pipeline stats recently, and it was something like somewhere between 300 and 400, right, coming to the Upper East Side over the next 12 to 24 months, and they're all, $2,500 plus per square foot.
Right.
So, and that 2nd Avenue and 3rd Avenue corridor, which was maybe a decade ago at 2,000 to 23, all of a sudden is 25 to 3,000. And so that's a pretty significant jump.
Yeah, it's amazing what's happened on the Upper East Side, really since the 2nd Avenue subway was completed and then post-COVID, right?
Yeah.
I mean, we've just seen a tremendous amount of construction, price appreciation from the new development standpoint at 20-30% from pre-2nd Avenue subway completion.
Yeah,
so
it's funny.
incredible.
And then you go across the park and there's basically nothing, right, on the Upper West Side. So I know we're bringing 200 West 88th Street to the market, which I would think, as the only game in town, should do phenomenally well, besides the way that it's been, developed from a design perspective.
Yeah, that's funny. Thanks for leading into that. That's perfect. So, yeah, I mean, we've been in the CPS 1 pre-sale previews for about 6 weeks now, and we have well over 130 people on a list, many of whom have said that they're interested, some who are actually same kind of thing. They're going to sell from some of the new development that they bought over the last couple of years to move into the newer development.
Yeah.
the initial response has been great. We'll see. There is literally no inventory on the Upper West Side. I mean, once 200 West 88th Street sold out, I guess everyone has to wait for Extel to build the Disney ABC site to have anything substantial coming, right?
Yeah, it's so much more difficult to develop on the Upper West Side because there's a large swath of it is all in landmark districts, right? So the Upper East Side is there's landmark sections of it, but not as from the park all the way to the river.
Yeah, no, we're super excited to bring that one to the market, and looking forward to seeing how it performs versus some of the others that have recently basically sold out. Just to go back to 80 Clarkson for one moment, my understanding was that was like a 10-year assemblage of the site as well, and it took them quite a long time. But yeah, as far as I know too, no one will ever build anything as tall. I was talking to Will Zeckendorf about it, and he said, like you said, that the views are protected. Nothing around it can be built to even half the height. I mean, it's really incredible what they put together. And I also think that probably with Disney moving their headquarters down there, that's good. That's a big plus too. Plus, a lot of Wall Street money coming. People like to be close to where they work, even if they can afford to commute, right? Or afford, to take a driven car into the city. People like to be close to work. We're going to take one more break, then we're going to talk about Brooklyn a little bit. We'll be right back.
I'm Brian Scott Cohen, one of the top loan originators in the country, and the #1 mortgage originator at Guaranteed Rate Infinity. Guaranteed Rate Infinity arguably has the most advanced tech in the industry. Our completely digital loan process makes it easy and efficient for homeowners, from a 15-minute pre-approval to the digital application and through closing. My team and I would love to help you get into the home of your dreams.
All right, welcome back. So we've been speaking about Manhattan a lot, but we don't want to forget Brooklyn, which is an amazing borough has seen incredible growth over the last 10 to 15 years in new development. But what we saw in the last quarter was actually a drop in contracts. And again, talking about supply demand absorption, Jay, what did we see happen in Brooklyn in the last quarter? And then we'll talk a little bit with Robin about what we see happening in the future.
So just to make it relative, to go back to Manhattan for a moment, Manhattan has been, we talk about reversion to the mean, that long-term average. Manhattan has certainly showcased that the last year. Very normal contract activity. In Brooklyn, like you mentioned, it was down about 20% from the 10-year average, but that's been the case for the last year. The last 4 quarters has been about 20% under average. Now, our thesis, do we think that is a demand problem? And I think we would all agree, no, we don't. We think it's a supply problem. So when you look at just some overarching stats, Manhattan real inventory, or real supply as we call it, that's active and in shadow, right? There is about 2.5 years, okay? On the pipeline, there's about 2.5 years, okay? Now this is Manhattan. When we look at Brooklyn, we see about 18 months of real supply and about 2 years of pipeline. Now, within that, this is really where Robin likes to, you say, like supply and demand, and we've really, through Robin's directive, have drilled deep into demand, into supply. There's, of that 18 months in Brooklyn, what you have is about 25% in the largest 5 buildings. Okay, so if you're not a buyer for those 5 buildings, now you're looking at closer to, 13, 14 months of inventory, right? And then about 40% is in very small, and we can't even say boutique buildings because boutique in Manhattan means a different thing. When we say that in Brooklyn, we're talking about literally 2, 3, and 4 unit buildings.
Like townhouse conversions.
Right. And maybe people are looking for amenities, some sense of community, and you don't really find that there, right? Now, if you want those Manhattan-style amenities and communities, then you're looking at some of the really expensive, developments, larger developments in Brooklyn,
right?
And these are really pricey. So Brooklyn has, it's almost extreme at this point. 25% 5 buildings. Several of those buildings are very expensive, or you're pushed to the other end of the spectrum, which are, essentially, like you said, townhouse conversions.
Right.
So Brooklyn, it's almost a trifurcated kind of market there. Right. It's really, it's really interesting. So we think it's that combination that creates a scarcity that's that's downplaying the actual demand that's there.
Right. So 26% of the supply that's on the market or in shadow right now is in five buildings, and those 5 buildings are probably 5 years old at this point or more, right? So in some ways we may actually be seeing buyers who are looking for something newer, a little bit newer technology, newer finishes, a little bit more updated. So Robin, as you look at the market in your business development hat, do you see an opportunity in Brooklyn?
Tremendous. I mean, I would say there's more opportunity in Brooklyn as a whole than if I were to compare it to Manhattan as a whole. You've had success stories with Naftali's project over on South Williamsburg with Williamsburg Wharf. Two Trees is now, I think, almost 70% sold on the Domino sugar factory
And they're
site.
like 2,200 a foot or so, correct?
Yeah,
It's
So
right,
Brooklyn,
very
I mean,
expensive.
is comfortably over $2,000 per square foot. And even for some inland stuff, there was a small building that just went on the market on Kent Avenue on the other side of Kent. I think it's 127 Kent, 30 or so apartments, over $2,000 a square foot. And they've, I think, put into contracts roughly 30 to 40% in the first 2 months of the year.
Wow.
So there's definitely pent-up demand in Brooklyn. And most of the development is rental.
Yeah.
Right? The whole Gowanus is all rental because of the way that it was rezoned and the opportunity zone capital that was attracted to Gowanus. And then downtown Brooklyn, for the most part, is all rental, with the exception of the tower, right, with JDS and now Silverstein.
9 DeKalb.
9
Brooklyn
DeKalb,
Tower.
Brooklyn Tower. And, if you looking to the future, as Jason was saying, it's just a lot of these kind of smaller buildings. We don't really have anything of sheer size coming in the future. So I think it's a tremendous opportunity.
All right. Well, looks like there's an opportunity to find an assemblage there and do something there.
For sure.
Well, this has been fantastic. In closing, Jason, what do you see going forward? Do you see an opportunity as we collect more data to better predict these trends in the marketplace? What are you doing to help make that happen? I know technology and the city needs to help us out with a little bit of information as well. But what do you see, like 3 years from now, how do you see us predicting the market versus today?
Okay, good question. So right now we have a combination chart. It's a multi-dimensional chart, okay, that allows us to pinpoint whatever side of the trade you're on, where the opportunity is. So where things are, where inventory is tight, or where deals are to be made. So if you're a buyer, you're on the other side of the developer, right? But we have a chart for this currently. But we want to do this with predictive analytics, right? We want to see because again, you can't build a building in 24 hours. If you could, we'd have the most amazing information for a developer. But we need to predict this out, the life cycle of a building, right, which is 3 or 4 years. So we are working on that. AI is certainly helping because there's a lot of heavy lift to because the data points we need, which are bedroom counts and pricing, to infill this model or to backfill this model. But that's where we're going. And we will eventually achieve that. And I think that'll be a tremendous tool to show developers, because right now, a lot of the market reports, we're just handcuffed. And the idea is we're giving insights and certainly interesting observations, but we need to predict, because that's where the real value is to our clientele.
Absolutely. And if we can provide those tools to Robin, then Robin has an opportunity to help the developers that he works with to make better decisions, maybe take a little more risk than they normally would have, because they see that the information is valid versus, 10 years ago, literally it was throwing some darts at the wall and trying to figure out where the next couple of years is going to go. I think our next conversation should be about AI and real estate and how we're going to use that in the future to fine tune, our predictions for the future and our unit mixes and sizes and where the holes are in the marketplace. And that should be something fun that I'm sure we'll all look at. Robin, in closing, what do you see happening over the next year or two in the market? Do you foresee this demand for the high end continuing? Do you think that there's an opportunity to even go higher?
I would say that the demand seems like it's relentless right now at the high end. So I don't think that you're going to see that back off personally. And I think as we look to the future, what I've been noticing on the like investment sales style side of the business is there's finally some family office and institutional capital coming back into the business. And that truly leads the market as it relates to us getting more supply. We need the capital to back our developers, right, to put a hole in the ground and to build more in the future. And that's, we just started on a new project, and we had a capital provider, invest all the way up to approximately 90% in a capital stack, which was great to see more capital coming into the condo business. So as we can point to all of these examples of success that we discussed over the last half hour, that to me is so much more palatable, right? Because then these equity providers have more conviction in their investments, so that we now have this sample of 5 or 6 success stories. We really didn't have a lot of that over the last 12 to 18 months. So I'm optimistic that more land is going to start to sell, and it's really going to be because we're going to see more capital come into the game.
Yeah, I think that's super important, right? You need the investment, you need the faith in the city and the marketplace in order to get to that next place. So what I'm hearing sounds like the future looks good. New York City is certainly thriving. A lot of money coming into New York City real estate, which says that regardless of how many times people want to write New York City's obituary, New York City's here to stay. New York City's thriving. Not everyone's moving to Miami, and even if they move to Miami, they still want to live here in New York as well. Till next time, thank you.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.